trend angle going down. How it tends to break down below the support, which it did, and then it actually broke back up right afterward. So the wedge plays tend to do that. And this is just going back, checking to see if these lines are historically, mental price lines for the stock. And some investors have a rule that says if a line acts as a support or resistance 3 times, then it's a stable line. And once you have a stable line, more than likely you can go back years into the stock and that same price line will be there. And the reason for that sometimes is because certain sectors have sweet spots or sweet ranges of price where their stockholders are just for some reason cognizant of those price lines. So the stock will react to those when it gets to those price lines. This is a downward trending stock pattern, but as you can see, it broke out of it. And when it breaks out, draw some more lines. Figure out the next pattern for it if you want to follow that stock. If not, then just go on to the next one. That was an upward wedge and it broke up. Upward trend into a downward trend. Got to draw the lines to go with it. And then it broke out of the downward trend. Now, when stocks break out of these trends, when it breaks out of these channels, it has a behavior that they like to follow. For example, if the distance between the support and the resistance is $5, if it breaks above the resistance, normally it likes to create another resistance above that previous resistance of $5. So these channels are normally the same distance apart. Yes, and I am right. There's no excuse. Darn it. Shoot, I might play this beat to look at my stocks every day. I know you can't see me dancing, but I'm dancing. All right, we're 16 minutes into looking at stocks, and we're not even halfway through. This is a play that I got into yesterday on that line, and I got out of it later on today. That was the 35% move that I think I posted on the chat line on the group me. More channels, those lines, man. If you make some good lines, you can probably stick with the stock. Like if you want to follow a certain stock and learn its behavior, you can probably like just babysit some stocks and always have them to play. If you learn their behavior, you can do it. Intel, I used to know Intel because I at one point I was only doing the Dow 30. So I knew Intel very well, but since I was only looking at that list of 30 stocks, there was only a small window of time that I had to play that, so I had to look at more. Back in the past to see how that line's working. See if I can draw another line somewhere. It's a good channel. Is that JPM? Yep, JPM. JP Morgan. I made a play on JP Morgan today, in fact, based on those support and resistance lines that I had up there. Kellogg, this looks like an easy play to make. It's just that it's gonna take a long time. I can see it already. It looks like it's gonna take a long time to mature. But if I was in investing mode, I would play that and just wait it out and make the money. But since I'm doing my 500 to 100,000 joint, I want to make, and this is just me, you can do what you want to do, of course, set up your own plan, but I'm trying to really rapidly grow my small lump sum into a big lump sum quickly. And when you have a lot more money, and that's something that I'll go over also, when you have a lot more money, there are other plays that you can do that are safer. They take longer, but they are absolutely safer, less risky. I'll say that, less risky, and you don't even have to pay attention to the stocks that often. As that adage goes, the bigger the risk, the bigger the reward. And as far as the stock market goes, options, just playing options like this is supposed to be the riskiest, or the riskier plays. These aren't the riskiest. There are some option plays that are really risky, and your broker won't even allow you to do them unless you have like $20,000 or $200,000 in your account already. So but you can definitely just buy stuff and sell it later. Those risky plays are plays where you sell stuff first and then go to buy them back later. That can be risky, and you have to have the money in your account just in case. Just in case when you buy it back, you buy it back for less than what you sold it for. That looks like a good line right there. Now, that's Murphy oil. Yeah, I would definitely play a put on that. If the stock does what I want it to do during market open. Looks like a good put play. Get it to bounce off of that resistance up there. All right, went to the last few minutes of this right here. I think 1027. Yeah. I end the video before the stock market opens, because when the stock market opens, stocks do some crazy stuff. The prices do some crazy stuff. And that's a video and a lesson different from this one. There are some plays that you would want to make in the beginning of the stock market when it opens, during that crazy fake out time. And there are plays that you want to make at the end of the stock market day, when the stock market closes. But like I said, those are different lessons, and I'll explain those Oracle. I made that play. I think I'm in it right now. I got up to 40% today. Same day I sold the FLRs. But since it's uptrending going into a resistance line, I'm expecting it to break above that resistance line. And that's the one But yes. This is the most boring part of trading. I mean, it can be exciting to you if you keep your interest in it and you're excited about finding patterns and actually doing work. This is the work part of it. Work for an hour, and depending on how much you're trading, man, if this is a $10,000 account and you can make 20% every day, come on, like that's great. And once you start trading, you'll see that 20% isn't even hard. 10% is child's play. But when you're starting with a small amount, you have to make that 30, 40, 50% just to clear the commission price. All right, that's it. Questions? Holla.